Wars at present, with other possibilities on the horizon. President Trump's tariffs and trade wars have caused financial uncertainty, to say the least. Secondly, I can't think of anybody better to talk about this topic than John Hewison, our Treasurer, since 2021. After studying accountancy, John moved into advertising and marketing, enjoying a successful career in senior corporate management roles, mainly in import and wholesale with the Brash Group until 1983. He then formed a consulting business until he encountered the fledgling financial planning profession in 1985. He since obtained a Master's in Financial Planning and is a certified financial planner. He's also built the highly successful independent financial planning business Hewison Private Wealth, HPW, into a company that has 6 equity partners, 18 senior and associate advisors, and employs a total of 45 people. Wow. John is a life member and former chairman of the Financial Planning Association of Australia, former director of the International Financial Planning Standards Board. He's also a fellow of the Australian Institute of Company Directors and Justice of the Peace. John retired from HPW in 2020, but remains an equity partner. John Hewison.
Thanks, Tim. Good morning, everybody. I've got a lot of stuff to go through here, so I think we'll keep questions till afterwards. I'll get through this as quickly as I can. So basically, I'm going to touch very quickly on the economy and then look at the effects of geopolitical crises on the markets historically and at the moment. I'll look at the state of the nation, which will be a horrific experience, and talking about managing money in times of crisis. So with that, we'll get moving. Firstly, a disclaimer, although I'm retired and not licensed to give advice, this is a generic presentation and not meant to be personal financial advice. In other words, I take no responsibility whatsoever for what I'm about to say.
That didn't work.
I'm not an economist, but obviously I have to be across economic issues in managing people's money. So there are many things that affect the economy, but when it comes down to it, the basis of the economy is the laws of supply and demand. When supply is plentiful and demand's low, prices will go down, and when supply is less than demand, then prices will go up. And there's a lot of external things that affect that, and of course it influences the rate of inflation, which is the Reserve Bank's measurement for managing the economy. This is a history of the CPI movement in Australia. And if we look back, I'm sure we all remember the bad old days of the 60s, 70s days when we were constantly going from boom to bust, credit squeezes, and the peak in interest rates back in 1990 in the high teens. But over the most recent years, you can see that the management of CPI in Australia has been pretty flat. If we look at the cash rate, it pretty much mirrors what the CPI rate. Of course, the anomalies are at the start in 1990 when mortgage rates were about 18%, and then in COVID, where the cash rate was 0.1, interest rates started with a 2. They're now probably starting at 6. So looking at looking at the current state of affairs, it's quite likely that the RBA will drop interest rates by 25 basis points today, which will take us down to 3.85%. It's interesting that the average interest rate over that period of 30 odd years is around about the same. So there's a lot of talk about how much interest rates are going to drop and how quickly. I don't think there's a lot of wiggle room, to be honest. because the Reserve Bank can't afford to not have wiggle room to try and boost the economy if things go into recession. Well, frankly, I think we're in recession now. It's only really because of external matters like the cost of energy and the cost of fuel, which boosts up prices, and that's keeping us in a apparent inflationary position. But it's not based on demand, because people are doing it tough, and I think we all know that experience, that a lot of people are finding it very difficult to make ends meet. So I think there's probably going to be some further movement downward, but not a great deal. The government's not managing inflation and giving people money all the time is not going to help. So this next lot of giveaways of energy offsets is probably going to have an inflationary effect. So it's a real balancing act at the moment. And I think the Reserve Bank's made it clear that they're not going to move from their 2 to 3% inflation margin. I think recession is quite likely. In fact, I think recession really is in action as we speak. So, looking at the effects of war on geopolitical events over history, this is a scale which tracks geopolitical events since the Pearl Harbor attack. So it's probably a bit irrelevant because it's too far away. But you can see that the one-day return it's not that great, but we've very quickly recovered, and over the 6 months to a year period, in most cases we've recovered and gone back into positive territory. That's the US Dow Jones Index, and that's just another graphic version of it. And you can see that the market is constantly moving up, and the downturns are quite small in terms of time. Now, this is the ASX 200, and you can see that the Ukraine war and the Israel-Hamas war has had no effect whatsoever. And historically, there's been little movement. The September, you can be careful with some of these tables, because the September 11 attack did have a downward movement on the market, but the market was already down because of check wreck, so it was already in a downward movement. And that's the graph that obviously indicates that the trend line on the Australian market is quite consistently upward. Then, of course, we have the Trump factor. I mean, what can you say about Donald Trump? I mean, the man's an ignorant narcissist, and he's just taking this sledgehammer approach to frighten the hell out of everybody, and then try and sit down and do a deal. And it's basically, this is the US trade balances. And you can see that his problem is China, Mexico and Canada, because they're America's in a negative balance of trade with those countries. Why he has to go at Australia is beyond me, because for decades we've had a surplus trade position with America. This argument is ridiculous. I mean, this is the fact of life. We buy stuff cheaply from people that sell it cheaply, and his notion that he's going to bring industry back into America by putting tariffs on stuff from China is just nonsense. So I think this is just going to be a bit of a storm in a teacup. He'll come out making ridiculous statements and might have a very short term on markets, but I don't really think in the long term it's going to have a huge impact on the market trends that trending upwards. So I think short-term shock waves, I don't think there'll be any long-lasting effect. And I think he's already had pushback from the West Wing and Congress. There's midterm elections in Congress. If he's damaging the American economy, they're probably going to have a problem. But I don't really see it being a long-term issue in the markets. So obviously, if markets do decline, in a time of war and crisis, there's always going to be market winners. And so obviously, in the time of war, the defence industry is going to be the winner. And these are just a couple of examples. The picture on the left is a Boeing F-35 fighter jet. The tail section of that plane, which is full of technology, is manufactured in Moorabbin. And this is a Bushmaster all-terrain vehicle, which is globally recognised as state-of-the-art and in high demand. It's one of the main support we're giving to Ukraine. It's also used for firefighting equipment, firefighting and so on. The Australian government's just placed a $100 million order with this company, which is in Bendigo. It's, as I say, it's globally in demand, that product. But what's happening in the market now, which is interesting, it always does happen when things trend, that there have been the creation of exchange-traded funds in defence companies. Exchange-traded fund is a managed fund which is listed on the stock market. So we've seen massive growth in this sector, and the defence sector this year's heading toward $13 trillion globally. Not that I'm not suggesting for a minute that you run out and buy defence stocks, but there'll be companies that benefit from in times of war. So really based on the historic evidence and what's currently happening, I don't really see that the current conflicts are going to have much of an effect on our markets. The markets are very strong at the moment, and there's no sign of any weakness. Some sectors are obviously going to be impacted, have been impacted by supply issues, particularly things like oil and gas. And as I say, defence-related industries are rallying. So the state of the nation, well, I'm not here to make any political statements, and frankly, having dealt with government over the years in my time with the Financial Planning Association, I've got a healthy disrespect for politicians of all colour. But I think we have to, I suppose I'm conservative because of my background, but I recognise that we need to have reformist government, and they're usually socialist governments. But in my opinion, in my lifetime, there's only ever been two standout governments, and that was Hawke Keating, who deregulated the finance sector, introduced capital gains tax. Keating introduced the imputation system to stop double taxing of share dividends. But most importantly, they introduced the compulsory superannuation scheme. Now, if they hadn't done that, we'd be broke today, because there are only two people working for every one retired. There's no way in the world that Australia's social security system, it just couldn't support it. So if they hadn't done that, we'd be in all sorts of trouble. It's a shame that the government governments aren't more long-sighted, and they're forever trying to rip money out of the superannuation system rather than keeping it strong. The issues for me, I'm sure all of us, is that our debt's completely out of control. I mean, the government there doesn't seem to be any move to try and rein it in. My personal opinion is that COVID was a bit to blame for this, because the government was forced to borrow money in a most unusual fashion at that stage, and I think they all stood up and said, wow, that didn't hurt a bit, nobody's reacted badly, we'll just keep on doing it. Because it just keeps on going on and on and on, but we keep on spending. The forecast budget, there was a budget surplus this year, but there's no surplus in sight for the next 10 years, which is even more frightening. And things like the NDS cost has blown out to 49 billion a year, which is higher than Medicare. Immigration is an issue because of the pressure it's putting on housing. Housing shortages and services and infrastructure are all falling behind. And most importantly, we're on our third warning from the IMF to cut debt, stop spending, reform the tax system. But of course we take no notice, we just keep on doing what we're doing. Matters to consider, this obsessive race to zero emissions at massive cost is just, it just doesn't make any sense to me. I mean, I'm a great believer in renewable energy. I've got solar panels and batteries and all sorts of things, but it needs to be managed, and we don't seem to be. We're having governments making decisions on the country's infrastructure, where it really should be in the hands of people who've got expertise in making those sorts of decisions. And then you've got one government wanting to go one direction and the opposition wanting to go the other direction. I mean, where does it all finish up? So I think this is a big issue for Australia, this management of infrastructure and proper planning. There just doesn't seem to be a fiscal management, responsible fiscal management whatsoever. And the taxes are just diabolical. I don't know, I've never experienced, I'm sure you know, we haven't experienced this tax on everything, and it just seems to be non-stop. And then the same issue with addressing housing shortage, the house system, cost of living. Our business has a foundation, and we sponsor a couple of charities who provide food for the underprivileged, and their demand has doubled in the last 12 months. And it's mainly just pensioners who can't afford to put food on the table. It's just dreadful. Well, the weather tax grab, this tax on unrealised capital gains is probably one of the worst tax I've ever seen. And the fact that the Treasurer has repeatedly refused to index it is a huge problem, because there mightn't be too many people now as a percentage of superannuants, but in 10 years' time it's going to be a lot more, and then 20 years' time it's going to be a large percentage. And the realities of this is that if you have for example, if you're in business and you've got your business premises in your superannuation fund, which is a perfectly legitimate and smart thing to do, and it has a capital gain, you can't sell it. You haven't got the money, so you'll get the money from somewhere else. So that means you probably have to sell other assets. It's just diabolical. I don't believe that. Well, the problem is, of course, that the Greens have got balance of power in the Senate, and they're after CGT, discounting, negative gearing, and dividend imputation. If that happens, the housing shortage will get even worse. And the fact is that negative gearing is just a the tax on a negative geared property is always the same if it wasn't negatively geared, but it works out to be leveraged capital gains tax rather than short-term income tax. But it's almost the same when you do the sums. And dividend imputation is purely to stop double taxation of company dividends, and it's quite fair. And yet it's been called a tax to the wealthy, a benefit of the wealthy. And I'll just chuck in death duties as a little sweep. Because it just seems to be that they're just looking at ways they can tax. Well, I pretty much covered all those, so I won't go through them again. But I just hope that some sense prevails. But at the moment, it doesn't seem so. Cover those. Wrong button. So now we come to Victoria. Oh no, I don't need to go through this, do I? I think we're all very much aware of it. I mean, this is just ridiculous. Just spending. Money. Well, I mean, Infrastructure Australia has already said that there isn't a business case for the suburban railways, but the politicians just ignore it. Where's the accountability? But the Auditor General's come out 2 years in a row and with scathing reports on the Victorian financial position. So Andrews just says that's educational, and Jacinta says no, they got the numbers wrong. I mean, they're treating us all like fools and totally irresponsibly. I think they'll be looking for other taxes. I don't know what. They've pretty much run out of anything over there. But charges like probate costs, service charges and so on are probably the next one. The problem also is that the opposition is not offering too much as well, so that's a problem. So hopefully that we can get some change in attitude going forward, but at the moment it's looking pretty horrible. Not so much for us, but certainly our kids and our grandkids. How they'll ever pay this debt off is just beyond me. So we covered that. So I'm going back to the end. So we'll get on to the good stuff, managing money in times of crisis. Markets are largely driven by fear and greed and in reaction to uncertainties. You see that, for example, if there's a rumour of an interest rate increase, you might find markets will get a bit nervous. But as soon as the increase happens, they say, well, I didn't earn too much, and the market goes back up again. So there's a lot of sort of nervousness before an event. I'm a Buffett fan, and our investment principles, my investment principles are based on intrinsic value, and cool winds will always win the day. So my formula for dealing with market crises is really in your strategy for overall management, not reacting to market fluctuations. This slide shows the average returns on the Australian Stock Exchange over 124 years, and as you can see, 80% of the time the market's positive. Only 20% of the time is the market negative, and the margins on the positive side are far greater than the margins on the negative side. So trying to if you're wanting to try and time the market on an 80-20 ratio, you're a better man than me, because I think it's just foolhardy. And the times that you get out of the market and then try and get back in, usually you're a little too late and you lose anyway. So it's far greater to manage a portfolio according to a strategy than just trying to time in and out of things. So when we plan strategy, or my philosophy on planning strategies, it's all about the objective, it's not about the investment. And a lot of people, when you talk to them about investing money, they immediately go to the investment. Where's a good investment that I can get? What's going to give me the best return? But what you really should be asking, where do I want to get? We're all retired. First thing we're going to have on our list is income. So we need to plan a strategy that's going to give us reliable income from our investments, so that we don't have to worry about our living objectives. But then there's all going to be other things along the way. You might want to plan for trips, you might want to plan for car replacements, you might want to plan for kids' educational costs, you might want to plan for helping your kids buy houses, you might want to plan for leaving a legacy. So all of these issues have to be taken into account and quantified, and then a strategy put together, including structures and so on, to get you to that objective. And sometimes they're multi-generational objectives. You see a lot of people planning their lifetime and into their children's lifetime and what they want to see happen to their kids. So this is the starting point of getting the strategy right, and then it's a matter of fitting the investments into that strategy as to how you're going to make it work. So when we plan the strategy, it comes back down to asset allocation. All sorts of assets. Investment assets really only fall into three categories: equity, property, and debt. And everything else is just a variation of that. There's all sorts of weird and wonderful and creative products that are out there, but they all come back to the same thing. So it's a matter of choosing a mix of assets with the characteristics that are going to give you the return that you want to achieve your objectives. So this is just an asset strategy. So you work out the strategy based on historical returns that's going to give you a reliable return to achieve your objectives. And the way to manage this is that when the markets fluctuate, you might have a fall in the international share market. That's an automatic trigger for you to sell something else and buy into this international market to bring it back to its strategic level. Do you understand that? And what that also does is mean that you're selling high and buying low. Buffett's never sold a share ever until recently, and the rumour was he sold a large parcel of shares prior to the Trump election, and the rumour was that he was jumping out because of Trump, but he wasn't doing that at all. He then announced his retirement, and he had a huge stake in Apple, which they'd made a fortune out of. So he sold down a few billion to give his successor, 62-year-old successor, some money to play with. That was his reasoning. So returning back your strategy back to the strategic plan all the time will automatically have you making decisions when markets fluctuate or one market outperforms another. So these are some basic rules that I have. Buy quality and plan to hold long term. If you're not going to hold a share for 5 to 10 years, don't buy it. You need to keep control. A big hatred of mine is I don't like managed funds. And the reason why is an early learning of mine in 1987 when the market crashed. A lot of my clients had managed funds, and then people panic. They sell their managed funds. The manager's got no liquidity, so he has to sell assets. The only assets he can sell are his quality assets, and so therefore you get dragged down by the actions of others who panic. So I have a rule on certainly my own portfolios, but in the past in my clients' portfolios, that we want to be driven. We're buying into the share market. We want to hold our own shares. We don't want to be influenced by somebody else. We never try to time the market, but we'll react to the market movements. To quote Winston Churchill, never let a good crisis go to waste. And we've had great success over the years. I'm not advocating, I'm advocating my philosophy, not the government. We've had good results over the years because when the markets fluctuate, for example, take COVID, the markets fell, and they were never going to stay down for long because of the nature of the beast. So we were in there buying and made a lot of money for our clients at that time, because the market was bound to bounce very quickly from something like COVID, and similar to the New York Trade Center was always going to bounce pretty quickly. Warren Buffett, be fearful when others are around you, and greedy when others are fearful. And people, it's counter this fear and greed thing. People get greedy and buy shares when the market's going up, so they're expensive. But when the market goes down, they get fearful and they sell that again. It should be the other way around. And most importantly, ignore the noise, because there's always a lot of noise. I mean, the media's all over this stuff. If they can tell a bad news story, they will get everybody to panic. So that's really my message in terms of managing in any sort of market crises. Take advantage of it. Don't be fearful of it. That's my presentation. I'm happy to take questions.
So, do we have any questions? Yes?
Yeah.
Duncan.
As a layman, I'm always fascinated by talk of trillion-dollar debt. Can you tell us who the lender is?
Sorry?
Who is the lender to give us a trillion-dollar debt?
China. There have been major lenders around the world, but China would be a major lender.
Or is it superannuation funds or no?
The debt, well, it's private and government debt, but mainly government debt.
Is the politician's superannuation fund going to be subject to this tax?
No. Disgraceful. I heard that yesterday.
Sorry?
That's disgraceful. I heard that yesterday, that politicians won't be subject to the unrealised capital gains tax.
Can I make one other observation? I have a friend in Hewison, and they had a freeze, I think it was last year, and after it was all over, I asked him, how did you get through? He said, I had no trouble. And I looked, they have nuclear, renewable, coal, gas. He's got a generator connected to his house. Are we going there as well?
Look, I mean, this argument about going 100% renewables is just nonsense. To give you a case study, my wife and I have got solar panels and we put solar panels on our house and solar panels on our beach house at a cost of about $30,000. And then, of course, they dropped the feed-in tariff. So now we have to go and buy batteries, so that's a $60,000 total is $30,000 for batteries. On our city house, where the solar provides 44% of our usage, and at our beach house it's nearly 100%, it's on there most of the time. So it's at a day, obviously, a third of the time there's no sun or more, and it doesn't blow every day. Wind, so there has to be baseline. And I mean, I don't know enough about it, but neither does the government. Where are the experts? And they're all throwing up conflicting studies about costing and all that sort of stuff. It's just totally confusing, and I don't think we're getting the answers we need to get. There has to be an answer. And you're right, I mean, the leading 30 companies, 30 countries in the world with reliable and cheaper energy, France for example, nuclear.
Thank you.
Rod?
Yes. Could you compare listed investment companies with managed funds?
Okay, a managed fund is a unit trust, and you invest your money into the unit trust, so you buy units in the unit trust, and it's not listed on the stock market. So the manager invests that money and you get a pro rata share of the assets and the returns. If there's a market downturn and people panic and sell their units, the manager's not likely to have any liquidity, any people investing in, because people will be sitting out but won't want to invest. So they have to sell assets. When the market's in decline, lower valued assets go down further than than blue chip assets, for example. So those are the assets that get sold. So therefore, your portfolio diminishes in value, both in dollar terms and in terms of quality. And here's the other rub. When we had people coming to us during the GFC, not only had the value of their managed funds gone down, but they got a capital gains tax bill because the manager sold the assets. So a listed company, if somebody wants to sell out, they sell the shares on the market. It has no influence on the manager or the portfolio at all. That's different.
So you're not critical of listed investment companies?
I'd only be critical of the investment companies if they didn't manage their assets well. But no, as a structure, I'd be certainly use exchange traded funds, which are similar.
Why is Warren Buffett so successful?
Because he for a number of reasons. Firstly, he bases all of his analysis on intrinsic value. So he'll thoroughly analyse a business, take into account their assets, their business, their management, everything, and he'll make his decisions based on that, and he'll aim to buy it whole. He's got no interest in selling. He loves insurance companies because insurance companies provide income, so it provides his portfolio with liquidity so they can buy more assets. And the good thing he likes about insurance companies, if they have a loss period, let's put up their premiums. So they've got self-protection. But he's a long-term buy and hold value investor.
Yes.
Should we be concerned about the rapid growth of the superannuation money that's going into the hands of people that probably are not skilled to manage it, and that's becoming a large amount of money for other purposes that we don't know much about, which is, sponsoring governments, and so the superannuation continually growing, being run by ex-union officials or government people. Is there a concern in the market about that growth?
Pushing me a bit political here. Of course, it's a huge problem. And I think the bigger problem is that money belongs to the members.
Yeah.
But it's being used for union sponsorship, political party sponsorship, advertising programs.
Big wages for people not skilled to get them.
Exactly. This is people's money. You've got no right to spend it like that. if I did that, or you did that in your self-managed super fund, you'd be taken to task, because there's a sole purpose requirement. So I don't know how they get away with it.
So who oversees that? Is that the ACCC, or is that political process, or is there a superannuation?
Australian Securities Commission, Investment Commission, ASIC,
ASIC.
or APRA. APRA.
We've got time for a couple more questions. Yes, Graham.
John, I've become a little bit delusioned with the piecemeal announcements by treasurers, both state and federal, over the years. Where does one go to read a genuine summing up of the entire budget? You know, the costs were this, and this department, and money coming in was this, and this, and this is the amount we have. Where do you get a simple, concise explanation of the whole budget?
Well, none of that is simple and concise, but you can get it on, just Google it and you'll get the actual government papers.
So what do you Google?
Australian government annual report.
I don't want it too detailed, I just want a nice simple summary of what's coming in and what's going out.
A summary, but it's still pretty detailed.
One more question. Okay. Well, yes.
John, for all of us who have sort of retirements and obviously looking at passing on funds, when you look at all these new taxes like franking and inheritance taxes coming down the tube from our government, is there any advantage in forming a trust?
Well, the advantage in having a trust is that you're able to distribute to various parties, so it can amortise the tax payable on the returns. Superannuation, of course, is most advantageous in terms of, which is a trust, most advantageous in terms of tax efficiency. So it depends on the circumstances. There's lots of sort of strategies you can use, which well, I couldn't go into those. But it's more an accounting question than it is a financial planning question.
Okay, thank you. Could I now please call on